In this video, let us discuss current affair related economic topics dated in Hindu on December 7, 2024. Amid high inflation, RBI retains repo rate at 6.5%. The Monetary Policy Committee of RBI kept the repo rate unchanged. However, cash reserve ratio has been cut by 50 basis points to 4%. In this above news, we can discuss what's an repo rate is, what's an reverse repo rate is, what's an cash reserve ratio is and its impacts on inflation, and what's an monetary policy committee is. Let's discuss what's an repo rate is. It is a rate at which commercial banks, both public and private sector, borrows from RBI by lending their government securities. For example, if the repo rate is increased to 6.8% from 6%, an increase of 80 basis point, the banks have to pay an higher interest to RBI. This will make the banks to borrow less from RBI because of higher interest rates. The banks will have less amount of liquidity, that is money to lend to people as a loan, which will decrease the money flow in the country. As the result, the inflation comes down. So usually, Monetary Policy Committee raises repo rate during high inflation. Here, inflation is a rise in the general level of prices of goods and services in the country. Inflation should be maintained between 4 to 6%. When the repo rate is decreased, that is 5.4% from 6% and decrease of 60 basic points, the banks have to pay less interest to RBI. This will make the banks to borrow more and lend more to the people because of less interest rate, which will further increase the money supply in the market. The repo rate is decreased during non-inflation or low inflation. What's an reverse repo rate? It is opposite to repo rate. It is the rate at which RBI borrows from commercial banks, both public and private sector, by lending their government securities and treasury bills. If the reverse repo rate is increased, that is if the interest is increased to 6.4% from 6%, an increase of 40 basis points, the banks have two options: either lend to RBI at a higher interest rate or to lend to its customer at a higher interest rate. Usually banks lend to RBI because of stable higher interest rate. When the banks lend to customers at higher interest rate, it discourages the customer to borrow less and money supply comes down and inflation is reduced. So reverse repo rate is increased during high inflation. What's an cash reserve ratio is? It is the reserve that should be maintained in scheduled banks of their net time and demand deposits with RBI. The ratio should be maintained between 3 to 15%. If the cash reserve ratio is increased, the reserve for the banks to be maintained with the RBI will increase and the banks have to deposit more money with the RBI. So the banks are left with less money to lend to customers, which will further decrease the money flow and decrease inflation. Usually cash reserve ratio is increased during high inflation or to control money supply. When cash reserve ratio is decreased, the banks will have more credit to lend, results in increased money supply in the market. It is usually done to increase the money supply and to stir a momentum of growth in the economy. Monetary Policy Committee, it has 6 members. It is responsible for fixing the policy interest rates like repo rate, reverse repo rate, cash reserve ratio to achieve desired inflation target. Thanks for watching this video.